Hey guys, what's up? This is Stock Retail coming back to you. Got a special weekend edition. I'm going to go through the earnings review. I've said I'd do that for a little while, and got a few other thoughts I'm going to share with you today. Pardon if the sound's a little echoey. I'm on the road and I'm kind of in a smaller space here recording. Just we had a family weekend here in Central Oregon. Beautiful place to be this time of year. So I consider myself lucky, but perhaps you're unlucky with the sound quality. We'll see how this goes. But I didn't want to wait any longer because first off, the longer we wait after earnings, the more we all move on to different topics. So I want to kind of cement this in. I want to show you how great the earnings were. I've also seen just a lot of noise on Twitter the last few days about a few different things. So I want to get my thoughts out there while that's still fresh. So without further ado, let's start going in there. First, I want to kind of ground us a little bit in the reality of where we are in very positive ways, by the way, but also just to speak truth to some things so that we can put to rest some what I'll call false DD that keeps getting shared with you. So the more you understand the truth, the more, I say on this channel, no trust me bros. That doesn't just apply for me. In some ways, I'm trying to teach you how to have your own thoughts and how to go back to sources, how to use data and not people's opinions on what's going on with our stock. So that applies to me, but that applies to everybody else. And I hold myself to the same standard. And that way I can go out and hold other people to that standard. And that's something, if you follow me on Twitter, I definitely do. I try to hold people accountable from time to time. Um, and I think we should do that as a community, by the way, because otherwise we get manipulative voices. But that's more something I'll talk about at the end of the video. So you'll see here, this is a view straight from the earnings release. You can go find this. If you went to the SEC's website, you go find this, and you'd see a couple things. So first off, you can see on the far right, so this is a list of all the debt. Interesting, you can go see the specific, it's called tranches, or I'll call it buckets. You can see all the different debt that we have. And you can see some great news, like since December 31st, since close of last year, we're down $400 million of debt. That's great. We've paid off a ton. And Sean talked about that in the call. What's more, I went back to other filings. If you go back to the filing before this so that you can get a full year, you can see we're down over $600 million on our debt. So we've paid off a ton of debt in the last year. And here's a simpler view of that. And this is where it's going to be important for you to understand, especially as we talk about dividends, right? So you've heard this whole thing about there are covenants on our debt that prevent us from paying dividends until we hit certain kind of thresholds and things. It's always been my point of view, those covenants are on the debt that's in 2026. Now, I want you to see some really positive things here. Look at 2024. We basically have almost zero debt due, right? So we're set up well to not have to really do much about our debt for a full year plus from now. Not for a full year plus, sorry. Effectively for a full year plus, as long as you pay off that small amount. Then in 2025, you can see that's still a very small amount. Consider this, that, we just closed the quarter with over $700 million of cash and equivalents. And you saw that we're selling a little bit more stock, so that brought in maybe 350 million. So we have over $1 billion. And in 2025, then we only have $100 million of debt due. So that right there tells you for the next 2 years, we're just sailing free. There's nothing to even worry about for 2 more years plus, right? To the end of 2025 when we get into 2026. So that's the first takeaway you should take from this slide. And this is all just coming from the filing. You can see, notice right here, you can see due 2026, due 2027, due 2029, and then you can see the amounts. So that's all I've done for you to put this into a simpler view for you. Now, notice we do have a very big amount due in 2026. In fact, that's the kind of majority of our debt, and it's on 2 in particular. It's not just on these 2, there's 3 bits of it, but it's in particular on these 2 tranches of debt. So one is this 1.9 billion on these senior secured notes, which you'll notice something here. It says senior secured credit facility term loan. That's going to be important to understand. And then you can see the rest is on something called a second lien. That's a payment in kind. I'm going to explain that in just a moment too. But what I want you to understand is it's my belief that the covenants are on this debt in 2026. I did email John Merriweather, and he did reply to me about, I asked to see the covenants, I asked what those were on. He said, I'm paraphrasing here, but effectively it's on all of our credit facilities or something. So basically you could either interpret it as, and I have to email him back to clarify this, but either it was saying it's kind of on all of our debt, or he specifically used that word credit, And you'll notice of all the debt, there's only one called this credit facility. So I think it means that our covenants are on this 1.9 billion, and that's what has to get paid off before dividends. But I'm going to be real with you. I'm going to level with you. I've not had a chance to look at the covenants myself and read the language, and I really want to get my hands on that, because then I could understand, what are those restrictions? Is it simply that we need enough positive cash flow? Maybe we're on the path to that. Do they actually have to be paid off? So I just want to be real with you that I'm giving you an opinion on that. My opinion is I think we need to pay those off before we start paying dividends. And that the reason that matters, if we're sitting on 1 billion in cash now, there are people who told you we were going to have dividends already this quarter, right? And I always knew that that was ridiculous and it was not true and would not happen. But there's people who pass that off as DD, and they pass that off as they know what they're talking about, and anybody who disagrees with them was an idiot. Who was the idiot? Because it turned out to not be true. And I want you to see this view so that you understand the real path to dividends. And I believe that means we've at least got to pay off this 1.9, perhaps the whole 3 billion, or refinance, right? So refinance could be coming. So I'm not saying we're going to have to wait that long for a dividend. I still think it's coming soon, but you need to understand how and what's the path there, and not just listen to people just sort of yelling at you and telling you if you disagree with them, you're stupid. Okay, so that's our debt. The biggest takeaway from this is there's really nothing significant due until 2026. And I'm going to talk to you a bit about, in fact, let's just cover that. So there's almost no debt due for 2 years, right? By 2026, just think of a runway that we need like $3 billion, or we're going to need to refinance. And I am so comfortable that that is going to happen easily. Consider it like a runway. Like a plane just needs a long enough runway to take off without crashing, right? And I've said that ever since 2021, to be honest. I've said AMC has this runway, has plenty of time, it's going to survive, it's not going to go bankrupt. I've been very consistent on that message, and I feel more confident than even then, because movies are returning, right? Like the strikes are over, popcorn is expanding. We just said we're going from Walmart now into Kroger and Publix and Amazon. Effectively, we're expanding into, I don't know, let's call it like 5,000 to 8,000 doors. Depends on how you want to count Amazon. We're going to start having the candy in theaters, right? But that's going to add some profit margins. That's going to keep more in-house. That's called vertical retail. You can kind of research that if you want to understand. But effectively, AMC is going to keep more of the margins. Beer and wine coming. What happens if Hycroft starts pulling precious metals from the earth? The merch has been growing. Adam talked a lot about that on the call. And all these artist partnerships. It's clear that we're going to have more partnerships in the future. Adam signaled that in the call as well. And I'll be honest with you, I'd already built that into my forecast because it just logically seemed that that was going to happen. So imagine now, picture yourself more than 2 years from now, and consider the growth that AMC has likely had. Like, that's not hopium, that's just logic. This is happening. So that's another reason why I'm not concerned. If we have now these more than 2 years before any real debt is due, we have more than 2 years to prepare for that. That's fantastic. But what you need to understand then is a good manager does not put their head in the sand and pretend this isn't coming, right? So Adam's living in a world where he knows this is coming and he's preparing for it. So when people say, why now? Why are we, selling stock now? There are things he has to do to build the business so that when the time comes, he has prepared the storehouses for that, if that kind of makes sense. So I'm sure that he's either positioning the company to refinance that debt, or he's even positioning to pay it off. And I actually have a point of view about some profits over these next couple of years. In fact, I'm going to talk about that here. So considering likely 24 and 25, so if I was to look out and do kind of napkin math forecasting, in 24 it's better than napkin math. I've actually looked at the list of movies. I'll give you guys my 2024 forecast soon. But if you look at, so now we're sitting on this billion of cash right now, right? And I told you, we basically need 3 billion from now till, like, call it 2.5 years from now. If I look at what I'm expecting in 24 and what I'm expecting in 25, and the growth of popcorn and the growth of these partnerships with artists, the return of the movie industry, I think probably we have a gap of about $1 billion. So in other words, I think we're going to raise another billion from now till that time, and we're going to have 2 of the 3 we need. So that leaves you with more equity raises, right? So over these next 2.5 years-ish spread out, he's going to have to find another billion that doesn't come from the business, or you're going to refinance, which is kind of what I think will probably happen. That's happened in the past. I think it'll happen again. So that's why I have zero concerns. But I want you to just see all of this. People are just saying dividend now, aren't giving you this level of information, and so I don't take them very seriously because they haven't looked at this. And I think that's important. I think I want you to understand the business so that you can never be misled. So the TLDR on all this is like, I'm just saying it's sort of silly, but we're good, fam. There's lots of time to solve this. The business is growing. Revenue streams are expanding. I would be willing to bet my own money. In fact, I am, right? I'm in this stock. I'm betting my own money that banks will be friendly to refinance, as they already have been, and that Shorty's days are in fact numbered. So that's just the quick overview of our debt, but that comes from this earnings release. That's the connection, and just helping you understand that I think it's going to take a little bit more work to implement those dividends. But knowing Adam, I am not going to be surprised if he has something up his sleeve that I didn't see coming. So perhaps it happens soon. There's ways around those covenants. Like I said, I haven't read them, but either way, that's our path. When he talks about the path to thriving, there is still more work to do. So when he sells shares, I trust him that he's saying, okay, it was time, because either he's investing in new business or he's paying off some of that debt. So I think that's good. Hey, I mentioned I would explain payment in kind. So if you go back, 1.9 of this 3 that's due in 2026 is that payment in kind toggle. Basically, payment in kind lets you pay with more bonds. So it lets you for a time not have to pay cash out for the interest. So all you have to know about that is there was a bank that worked with Adam to say, all right, we're going to buy you some time, but that interest basically is going to keep piling back into the debt and sort of add to it in a way if you don't pay cash. So it just gave AMC some flexibility. That's all that is, and I'm not going to spend a lot of time because this is not a payment in kind video. One more thing about debt I want you to see. I've said many times on quite a few videos that he'll pay off debt at a steep discount, which is effectively like making a profit. And you can see this was reported, just focus in on this third column, gain on extinguishment. So that means like you put out the debt, you pay it off. This was over a certain period of time. I think this was over the last 9 months, showing some of the debt they had paid. And so there's the actual principal that was repurchased, but here was the cost. So the point is, they spent 100 million, but they paid off 170 million of debt. So 97 of that was effectively kind of like profit. And so I just want you to continue to see this management team is doing a great job paying off debt and even doing it at a discount. And so that's helping us. All right, let's finally look at the earnings. So first off, how did Wall Street do? This was the second straight quarter that Wall Street forecast negative earnings while AMC delivered positive, and the second quarter where I told you we had positive earnings and I got it right. So I don't know, a little feather in my cap. By the way, there's been some people who tried to troll me a little bit on Twitter saying, why are you bragging about getting things right, effectively trying to shut me up. Guys, what I'm trying to do, and what I've said many times here, is I want you to start to see who are the voices of credibility. There are effectively a few different types of voices in AMC. There are some who will tell you the truth and who will speak with credibility and who mostly get things right and will admit when they're wrong. I hope to be that kind of voice. There are some who speak wild, misleading, hype, let's call it, but that is nothing near true, that I believe are managing your emotions. And there are some who are just here for clicks. They want to make money on Twitter. They want to make money on YouTube. So you need to start seeing who has credibility and who has integrity. So when I brag a little bit, one, it's just, hey, I'm excited. You make a good shot in basketball, you raise your hands and get excited. There's nothing wrong with that. So, I made the shot. I love it. I'm going to celebrate a little. But also I'm trying to sort of continue to demonstrate a resume, basically, and to say, hey, if I've been credible, if I've been right, then I hope that that's earning you deciding when people attack me, when people disagree with me, who has the credibility here. And I think that matters because I want you to follow credible voices that have integrity. I do not want you to be misled. So let's actually just be real. I'm looking at, this is something you do in forecasting. You measure yourself against what actually happened. And then we're going to get into the scorecard that I always share. So that's coming here in a minute. I'm just going to do the quick rundown, but the top line is I nailed it at 97% accuracy. And I've told you many times, forecasting earnings is a lot harder than forecasting the box office. So I'm really, really pleased with that level of accuracy, both on revenue and expenses. Basically, I missed one to the upside and one to the downside, and so they kind of washed out, and I was really close on earnings. All right, so for admissions, this is just awesome news. AMC outperformed my forecast. And so you can see I was off by 7% on that, so 93% accuracy. That was more driven by market share. I was surprised that at the level of the box office, there was more attendance than even the quarter before, even though the box office was a little lower. So AMC had some gains in market share. There's a little bit in there from currency conversions too. When I had done the preview, I told you that we would see some favorability on that. It was even more favorable than what I had forecast. I'm not a currency expert, so that's fine. I don't mind that I got that off just by a little bit. At least I had the concept right for you. Food and beverage, you can see I was really close on that, 99% accuracy. There's a little bit lower spending per person than forecast. So, with the increase in admissions, I should have missed food and beverage by more than food and beverage should have been well above my forecast. So something happened in the quarter, and I'm gonna have to do some digging, that people were spending less per person. I have a feeling that's just the third quarter blip, because if you remember now, 2 years in a row, there was kind of these discount days to drive attendance, like $5 movie days. What was it, like National Cinema Day or something like that too, that drives a lot of attendance. Those are not the average, let's say, or normal. It's kind of a discount customer, and so they're not spending as much. That's my theory, but I missed on that. I was real close, but just overall, I didn't love that food and beverage spending was lower per person than maybe in some other quarters, but it's still amazing compared to pre-COVID, and you can still see we made a ton of money, and we're basically where I said we would be. On other revenue, right now I'm rolling my popcorn number into that. I don't know if AMC is rolling food and popcorn into food and beverage, which would be logical, or if they're rolling it into other because it's out at the grocery stores. So for now, I've rolled it in here just so you know, and on that I nailed it, so 99% accuracy. On total revenue, you can see that's that 97% accuracy. I missed a little bit, so AMC beat my number, basically on admissions and on currency conversions. And then on total expenses, so operating expenses were a little bit higher than I thought they should be, and that ends up making sense to me because of the increased admissions. You got to have more people serving those patrons. And then film costs were just a little bit higher than I had forecast. So those are my misses there. On earnings, you can see I was real close. I said a positive 8.6. We had a positive 12.3. So to only be off by $4 million on a $1.4 billion business, I'm taking that as a win for sure. And you can see I was a lot closer than Wall Street. Wall Street said the consensus forecast was for a negative 36. So if I was off by 3 million, 3.7, they were off by almost 50 million. So I beat Wall Street quite a few quarters in a row now. So I'll take the win. All right, let's talk a little bit about what else was in the earnings that tells me how is management managing this company. That's the real thing I look at. And I want to know what's the direction of this company, and sort of it's a scorecard for how is the management team doing. And I suggest you judge a management team by the results of what they manage. You've seen other videos where I've talked a lot about that. Why would I judge Adam by what's happening, in Washington, D.C. and what's happening on Wall Street? He has no control over that. What he does control is this business, and so I'm going to judge him by what he can control, right? So let's do that. Let's go through here. And then what I also just want you to kind of take away from that is listen to the voices who are judging him by what he cannot control and start to ask if those are manipulative voices. All right, so expenses as a percent of revenue. So this should tell you, are they keeping expenses in check? Are they making the business more profitable? You want to grow revenue faster than you grow expenses, and that's exactly what they've done. I'm giving you a view all the way back to 2018. You can see these middle areas are obviously, the results of the pandemic, where basically expenses got to the point they were eating up more than the revenue, right? So as far as revenue growth versus expense growth, you can see we are more profitable now than both 2019 and 2018, which is what Adam shared in the call and what I've been telling you for quite a while. And I'll say another feather in the cap. Pretty much the first video I ever made was more than a year ago, and I was explaining the business model of AMC and what I saw in the financials, and that as movies returned, AMC would be more profitable than pre-COVID. Now, I told you that more than a year before it happened, so I'd like to suggest that should lend some credibility to my voice as well. And those who want to attack me on Twitter, and you know who you are, good luck with that. I've got the receipts. All right, so revenue over time versus debt over time. We're going the right way, right? Like, I'd love to see this green bar continue to go up. I'd love to see this blue bar continue to go down, and that's what we've seen. So that's fantastic. I do have Q4 here on the revenue line, so that's a forecast. I suppose I should have wiped that out and just shown you actuals. And the only reason that's dipping is, we had some movies move out due to the strike. But thank God for Taylor Swift and Beyonce and popcorn growth, and all of which Adam had a hand in delivering, or that line would be a lot worse. So those guys managed to basically rescue the quarter, and kudos to them on that. But the main thing is, you can see we are going way up and to the right on revenue while we're going way down and to the right on debt. Fantastic. Love it. All right, so how about total liabilities? Because, the liabilities aren't just the debt. There's also a significant amount of lease liabilities and deferred rent. You'll hear Sean talk about some things like that. So I'm just also showing you the view of total liabilities, which is also going way down. You can see from the first quarter of 2021, we were effectively at like 13 billion, and now we're basically all the way down to 11 billion. So a $2 billion drop the last 2 years in liabilities. Meanwhile, assets have been recovering, so that's good. So they're going to continue to clean up the balance sheet is what you're going to see. Admissions per movie. Management is bringing in profitable business per movie, has continued to go up, which is phenomenal. It's almost shocking to see, because, and what you see here, like in Q2 you had Q3 you had Barbenheimer, Q2 we had a lot of summer blockbusters, but still, to continue to see that per movie we're making more money. What happens as more movies come back, right? That's a big, big deal. And yes, they're not all going to be blockbusters, but we've continued to see this go up as the amount of movies has increased. So I am just thrilled at seeing these results. There's a view that I've tracked for a long time. I think I've only shared it once or twice, but it's just something I'm watching. I would like to see this management team grow earnings faster than the box office is growing. And now that we have popcorn and we have distribution and we have concert movies and all of that, it's pretty clear that's going to happen. So what you're going to see, I told you some things more than a year out last year. Now I'm telling you what to watch for in the next year and a half. This orange line is showing you the earnings growth. Okay. Meanwhile, actually this is even earnings per share growth. I should show this with earnings growth. It'll make it even more pronounced, because earnings per share gets dampened by the fact that there's more shares. If I showed you just earnings growth, this would just be off the charts kind of. So I will adjust that in the future. You can kind of hold me to that. But basically, you're effectively looking at earnings growth on the orange line and the box office growth on the blue line. Now, of course they track, right? We're a movie company. They track each other. But notice from the last quarter, we had a significant jump in the earnings per share while the box office actually was down a little. You're starting to see the impact of Adam managing the expenses and diversifying our revenue. And so what you're going to start to see, I'm just telling you now, is you're going to start to see earnings growing far faster than the box office itself, as this company is more healthy and more diversified. That's going to be fantastic. Oh, just a business term I'm giving you, so I called this G2N. That's just kind of insider speak. It's short for gross to net. Gross to net means your gross revenues, what you take in, and then you walk your way all the way down to the bottom line of what's your earnings, gross to net. And if you have good gross to net management, you make your profitability better. All right, so positive free cash flow. Guys, I saved this one kind of for last of these charts because I really, really want you to know what a big freaking deal this is. If you'll notice, we've only had one other positive cash flow quarter since 2019. That was Spider-Man No Way Home. No Way Home? Yes, that was No Way Home. Anyway, since then, you can see we had a significant drop in our cash flow, but this is the kind of first time in basically 2 years that we had positive free cash flow. It is a metric I've had on the scorecard, which I'm going to show you in a minute. I've had it on the scorecard for, 2 years, and one I've been watching for a very long time. And this is, more than almost any other metric, going to be the real nail in the coffin for Shorty. If you have positive free cash flow, you can operate your business effectively forever. This is a really, 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 really big deal, and I want you to go read up more about FCF, or free cash flow, in finance, and what that's a measure of. Okay, speaking of the scorecard, a little bit of an eye chart, but I'm going to go through it quickly, try to keep us moving today. This is something I have looked at every quarter for, gosh, I don't know how long, but seriously, 2 years or more. And for a while, it was just an anti-FUD. In fact, you can find me on Reddit. Maybe the first time I shared it, I think I called it like, I think I called it the anti-FUD scorecard or something like that. The whole point, I called it the FUD Buster. Because the point is, I wanted you to see, back then we got yelled at a lot about fundamentals, right? And I wanted to just show you, all right, fine, let's let the fundamentals themselves tell us how we're doing. And that way we don't have to listen to manipulators. You don't have to get your news from a tweet. You can get it from the numbers themselves that come straight from the filings. So that's what I'm giving you here. And I'm giving you the way kind of a business person would look at their business, and I hope teaching you a little bit too. If you're new here, I've shared a few times, I have 2 master's degrees in business. I worked at a Dow Jones company. That means kind of one of those 30 companies that's in the Dow Jones index. I worked there 21 years. Just learned a few things about business, that's all. So that I want to share that with you. All right, so I have been looking at current assets. Really, what is our liquidity? And I have not changed this scorecard. Literally, it's the same scorecard I've done every quarter for more than 2 years. So that also we can look at over time then. We closed the quarter with $980 million in current assets. So in there, I'm including a couple other things that aren't just the cash. So you've got accounts receivable, you've got restricted cash. So that 980 million, that's why that doesn't match what Adam talked about, the 730. That is an 8% gain year over year. While, remember that slide I showed you where I said we paid off $600 billion in debt? So think about these connected for a minute. We have more cash than a year ago, and yet we paid off $600 million in debt. Your management team has increased cash while decreasing debt by $600 million. That's a big deal, okay? That's a big deal. Now, yes, that's had to come in part from equity sale. But as you see, I just showed you, we're starting to have free cash flow, and I believe that gets a lot bigger in 2024 and then a lot bigger in 2025. We're going to start to be at a place where the incoming cash is what builds our war chest. And Adam has gotten us there. So again, how is the management team doing? Well, they've gotten us here without bankruptcy. Fantastic job. All right, attendance was up 38% year over year. And you'll notice 40% in the US, 33% internationally. So we're growing kind of everywhere. Fantastic job. So I'm giving that kind of a green light. This is kind of a red, yellow, green type of scorecard just to see how we're doing. Food and beverage. All right, so we had plus 43%. Now that's great because look at, we had 38% growth on attendance, but 43% growth on food and beverage revenue. So we're outpacing even kind of attendance year over year growth. We were down a point in margin. So what that means is the food and beverage expenses grew a little bit. This is also part of the FUD-buster. People in the past have said, oh great, you're growing food and beverage revenue, but that's just because of inflation and your costs are still growing. Well, I've tracked this, like I said, every quarter for a very long time. And basically the food and beverage cost as a percent of the food and beverage revenue, so that's that margin I'm tracking, has been really consistent. We have not seen erosion on that. So that's really good. And so net, what's the actual amount kind of we keep after the food and beverage expenses, went up $120 million year over year. Now it's nearly flat to last quarter, but last quarter was all-time highs. So effectively what I'm telling you is 2 quarters in a row, basically we had all-time highs on food and beverage. Awesome. Great job, management team. All right, so admissions, $250 million growth year over year. That's that 46%. So that's even outpacing attendance growth, which tells you basically ticket prices are up a bit, which I'm showing you at the bottom. So year over year, ticket prices were up about 60 cents a person, which is about 6% growth. So you've got the growth in attendance plus the growth in ticket prices got us $250 million year over year growth on admissions. Again, fantastic job. Okay, so one of the things that, I don't know, so-called, you can't see me, but I'm doing air quotes, smart money will look at is going to be our balance sheet. And they're going to want to continue to see a more healthy balance sheet. So that's why I show you some things from there too. And just think of this overall as like a balanced scorecard. You want to look at a lot of different parts of your business to see, again, how is the management team doing? How do I feel about them? So I look at assets versus liabilities. And when I say this scorecard has been consistent, what I'm telling you is I'm committed to sharing the facts. And in quarters where some of these have been red, I've shown you they're red. I'm just going to be real and show you the business results. All right, so assets versus liabilities. We want to see our assets growing and our liabilities shrinking. And that starts to be a healthier and healthier balance sheet. And something called leverage too. So you can see year over year, we are up 3% on our assets versus liabilities. We were at a 77.4%. Now we're at an 80.4%. That does mean assets are smaller than liabilities. We want to get to the place where they're bigger, and it's coming. As we pay off debt especially, and as we pay that deferred rent, you're going to continue to see our assets growing faster than our liabilities. I believe that about this team, and I believe it in the trend. All right, so operating expense as a percent of revenue. That is one of the most important ones on here for me. I want to see, basically you'll see kind of cash burn, or you'll see cash from operations. And that was one thing Shorty tried to tell you for a very long time. And you remember how loud I was over the summer when people were trying to say, oh no, we're still burning cash. And I was like, no, we're moving to positive cash flow. Um, this is something that I really care about because it's basically, does keeping the lights on and opening your doors and putting people in seats, does it actually make you money or does it cost you money? And that's another key sign of a healthy business. So year over year, we had a 15% improvement. Last year, operations basically gobbled up 98% of our revenues. This quarter, only 83%. So we're moving the right direction. It's the second consecutive quarter, by the way, that basically was at our post-pandemic best. So 2 quarters in a row, we're basically at that 83% mark. I believe, now this is a belief, I don't know for sure yet, but if we look at a couple things, one, the popcorn, I'm going to expect that I think that has better margins, let's say, than bringing a person in the doors to see a movie. So what I mean by that is our operating expense kind of leverage is going to continue to get better the more popcorn grows because you've got less people, I think, who have to manage that business. Now you might have some senior paid executives or something, but if you think about thousands of doors and tens of thousands of screens and how many people it takes to manage that, effectively at retail, let's call it, versus people managing shipping popcorn to the grocery stores. I think you're going to see this number improve as popcorn grows, and then I think you're going to see it improve greatly because of distribution. Because with distribution, we're taking in money from other theaters, but we don't really have the operating expense of managing those theaters. And so I'm really excited to see this in coming quarters. I think it's going to get better and better, which really just means profits get better. Okay, free cash flow, I already told you, just amazing. Look at this, almost a $300 million improvement year over year. That's the level of cash flow burn we had to now cash contribution. And so free cash flow was $8.4 million to the positive. And like I said, that's a $287 million improvement year over year. Only the second ever positive free cash flow of the post-pandemic era. Awesome, awesome, awesome. Okay, connected to cash flow, there's a metric I look at, which is accounts payable versus accounts receivable. What I want to see is accounts payable basically either going up or kind of being flat, and accounts receivable kind of going down. What that means is, so accounts payable is like I owe you. And so if I can take some time before I pay you, I get to kind of keep the cash on my side. Accounts receivable is you owe me. And if I can hurry up and collect from you, again, I get to keep the cash on my side. So this impacts your free cash flow. It impacts just what cash you're sitting on in your accounts. In general, managing APAR is just a kind of a thing you do in finance. And so I'm giving this one a kind of a yellow light. What you'll see year over year is accounts payable was down 6 million. So that amount that I owe out went down a little bit, but my accounts receivable, so how much I want to take in, went up by 26 million. So in effect, there's like $20 million more this year versus last year that's not in my side of the ledger, let's say. It's not any big deal. You see, we had the positive free cash flow. It's just if we're able to measure or able to manage that a little more, then perhaps our cash flow improves even a little more. But overall, it's not like a measure of profitability per se. All right, so our net loss gain, this is just the bottom line. You saw we had profits of $12 million. That's a $239 million improvement year over year, even with all the investments Adam has had to make in new Dolby or IMAX or lasers, or even just refurbishments, interest payments, paying off debt, rolling out popcorn. All of that costs money, and yet we are up $239 million versus the same quarter of the last year. And remember that we beat even the 2019, the same quarter pre-pandemic. Just awesome. Only our second quarter profits ever since kind of, let's say, the ape era, and the second in a row. So, all right, some bottom line bullets, and then we're finally done with this slide. In 1 year, I said we paid down the $608 million of debt, but we also paid off, oops, I left this as an X. I meant to go get that number for you. I'll just have to do that as a follow-up. But we paid off deferred rent over the last year. We've been cutting that smaller and smaller, and Sean talked about it in the call. And we have more cash and we have profits. So in the last year, debt down, profits up, cash up, fantastic job, green light. Second consecutive quarter of basically all-time highs on food and beverage revenue, so I already mentioned that. I want to remind you that, and this kind of shows up in our assets versus liabilities and some other spots, that we had a litigation liability. So there was a $115 million expense 2 quarters ago. That expense then showed up as a liability last quarter. And all of that you can thank the people who continue to sue AMC. The lawsuit crowd, who I believe are just working for the shorts, they basically cost you $115 million out of your company. And so that was showed up as an expense 2 quarters ago, then it was a liability last quarter, and now it's kind of been wiped out. So that is a reason why the assets versus liabilities has improved. You get to wipe that liability out now. Current assets are a little higher, and also, of course, kind of the property mix has shifted a little. There were some more closures over the last year and some more openings. So just really good job there too, but I want you to continue to know who's messing with you and what that's costing you. You know, imagine if we had never had that $115 million expense they'd have to write, what our earnings the last couple quarters would have reflected. It would have been awesome. All right, so positive net income, talked about that. Positive cash generated from operations, that's $100 million. You'd find that in the earnings report. So basically the impact of having the doors open and turning on the lights and projecting the movies was a positive $100 million. That's fantastic. And I think maybe the biggest of the post-pandemic era. I'd have to go back and check that. And then I mentioned positive free cash flow. Okay, I want to round out into kind of what I see on Twitter, and I'm sure this must be happening on YouTube and Facebook and wherever else you are as an ape. And thoughts on false DD and what people are doing to you so that you can spot it. That is my intent. I want to continue to show you what I see so that you can see it, and I just want the win for you. I want the win. I'm tired of, whether it's, you could take this not just about AMC, you could take this in life. I want people to be able to see truth and not be manipulated. That is just a deep desire of mine for you and for me. Okay, so first off, one of the reasons I believe what I'm calling false DD, and this is just false expectations, people telling you things that there's no way in heck were ever going to happen. And they're doing that for one of a couple reasons. Either they just don't know what they're doing, and that's at least semi-innocent, although it's still harmful, or they know what they're doing and they're trying to set expectations that could never happen. So setting false expectations is actually a way of manipulating you. You're being manipulated. I just went and found a few quotes on, in this case it's exaggeration, but I want you to just think about these and whether you think these are true. So somebody said, we always weaken whatever we exaggerate. And somebody else said, exaggeration is a blood relation to falsehood and nearly as blamable. And then Stephen Covey, who I have heard of, kind of speaks a lot on leadership. Every exaggeration of the truth, once detected by others, destroys our credibility. And there's that word, right? How many times have I talked to you about credibility? And makes all that we do and say suspect. I invite you to think about people who exaggerate out there and whether they are innocent or not. And at the very least, what does that do to their credibility? When they're saying things that turn out to not be true, they peddle it on you as DD, and then they never circle back and kind of say, whoops, my bad, I was wrong about that, right? And when they're consistently wrong, what does that say for their credibility and whether you ought to be listening to them? But here's why I believe that happens. I want you to just really understand. There is a saying, it's actually a Bible verse, it's hope deferred makes the heart sick. Okay, so there's this idea that, think about, like, if I exaggerate to you, if I tell you guys, let's say I do my Q4 earnings forecast, and I tell you guys, we're going to have profits of 300 million, biggest quarter ever because of distribution and all this stuff. And I could probably sound smart and give you all kinds of reasons. And then let's say we don't hit anything near that. But I've set up your expectation and you start to have hope. Okay, we're going to squeeze, we're going to make all these profits. This is awesome. And then it doesn't happen. What happens to you? You're disappointed. You're let down in something that didn't happen. I can bring you up in order to later bring you down. That's manipulation. I set a hope and an expectation that will not happen. And in the end, you get frustrated and you get heartsick. And now I can manipulate you even further. It's really easy to manipulate someone who is in the place of anger, in the place of fear, in the place of disappointment. So I'm bringing you there in a way by setting unreasonable expectations. And I want you to see a DM I got actually the day after earnings, and the day that Adam announced the latest share sale. And sorry for this one black bar, it's because I was hiding their identity, just out of respect. This person says, oh, they're so disappointed that, why didn't we see investments made? And I want you to really circle in on no dividend. Now they have a typo here, but we know what they're saying here. No dividend. Well, I've shown you the debt, right? And I talked to you about the covenants. And you can find receipts out there. I don't remember now if it was videos or tweets or both, where I was explaining there was not going to be a dividend yet. We did not have enough money to pay off enough. There was not going to be a dividend. There just was not. The DD, the real DD, told you that. But there were voices out there telling you, put it in the bank, arrogantly saying people who disagree with them are idiots. There was going to be a dividend, blah, blah, blah. Well, look at this person's response. And I can tell you there was a lot more. They ended up showing me that they DM'd Adam himself and told him where he could shove it. And they kind of, blew up and melted down. And you saw a lot of other apes melting down. So I want you to think about this saying or this verse over here on the left. Hope deferred makes the heart sick. If I can set false hope for you, knowing it will never happen, then I can turn your anger. Look at who they're angry at. They're not angry at the person who told them a dividend was coming. They're angry at Adam. But Adam was never going to be able to give a dividend this quarter. And I could just point to, and I'm not going to do it because I'm not into one-on-one drama here, but I want you guys to see just the general concept. I'm going to leave it at that. But I could point to, I've got the receipts, dozens of effectively lies that you've been told and sold as DD that are not DD. They're just falsehoods. Please, please, please start thinking about the voices you listen to. All right, but in summary, we had fantastic earnings. This is the second positive quarter in a row, and the first two in the post-2019 era. Awesome. Second time ever, and the biggest ever, positive free cash flow in the post-2019 era. Sorry, I guess I missed turning some of this text green, but we'll go through it. So third row, gross to net expansion is happening as revenue streams have been expanding and the industry is set for a full recovery. Boy, that's a lot to like. So there's no need for lies or false expectations. Just celebrate the positive truth. This truth is fantastic. I don't need to come to you and spread false DD. I'm going to leave it at that. All right, so why are we going to win? Shorts got in too deep and will need to unwind. Guys, if sometimes there is a bit of a trust me bro in something I'm about to say, so you don't have to trust me, but I'm just going to tell you something I believe. I believe I've seen some things that highlight and illustrate this is far bigger than any of us even realize. It's a big, big mess they've created. They're in too deep and they're going to need to unwind. AMC is on a path to thriving and has the time it needs. I showed you that. That's just DD. No real debt due for more than 2 years while Adam is growing the company. I'm on board for that. Apes are fighting for something bigger than just a stock, in my opinion, or a stonk, as I've said here. I think we're fighting to shut down manipulation, shut down the acts of darkness, shut down terrible people who I believe are trying to get you, and frankly trying to sideline me, but don't worry about me. It can't happen. I know who I am, and I know I'll never quit. And I like the stock. So, a parting shot. Sometimes people out there speak in code. I'm not going to explain this one. I'm just going to say it. But Shorty, and the people who want to sideline me, this is for you. Straight from the heart. Let's go.